Hello, it is Wednesday, December 11th, 2024, with Jason Shapiro from Crowded Market Report on a cold and rainy day in the Northeast. Um, so we had CPI today. It came in pretty much right on the expected number. Many argue that it's a little lower than whisper numbers. People were maybe expecting a little bit higher than expectations. And so because it came out sort of lower than that, we had a boom, right? People loved it because it means the Fed's going to cut rates. I think the percentage of the Fed cutting rates, the percentage chance of the Fed cutting rates at one point this morning went up to 100. Okay. So stock market loves that. And the Nasdaq went up a lot. The S&Ps went up, 42%, even more than 42 points. They were up 50 something points before selling off on the close. Interesting to me that while the Nasdaq went out pretty close to highs, the Dow went out on lows. Why is that? Well, I would argue that it's for the same reason that despite the fact that the CPI was somewhat lower than expected, let's say, and this was the bond rally after the CPI number, bonds basically closed on lows. And let's start with bonds. I continue to say the Fed cutting rates in an environment where there's so much liquidity in the world is very bearish long bonds, right? To me, it makes no sense that they're cutting rates, but hey, they want to cut rates. Bonds are going to get hurt. They have since they started cutting rates when they first started cutting 50. And you see every time that the odds of them cutting goes down, the long end goes up. And every time the odds of them cutting goes up, the long end goes down. This is discounting future inflation. The more Fed cuts, the more future inflation and growth expectations there are. In particular, in such a environment where there is so much liquidity. Is there so much liquidity? I mean, stock markets are on highs. Bitcoin is over 100,000, right? I would say that's Bitcoin, by the way, is over 101,000. I would say that this is an environment that there's no indication that there's a lack of liquidity. Now, of course, so, that's, I think, is why the Dow, getting back to that, went down. The Dow stocks are clearly much more interest rate sensitive than these tech stocks that are growing at whatever ridiculous percentage every quarter. And a 25 basis point, 50 basis point move in interest rates is not really going to affect them so much. But big industrial companies, banks, real estate companies, 25, 50 basis points in rates does matter to them. And it was a pretty big move up in rates today, in particular in the long end. So I think that's why the Dow outperformed so much. That's the story there. As far as other things go, energy's had a really good day. Crude oil had some news overnight where OPEC lowered their expectations for crude demand next year. That was somewhere in here. Crude went up. Then we had a inventory number, which for crude wasn't so bad. It was pretty much on line, but for heating oil and unleaded gas was bad. And you see the energies went down on that, and then they went up again. This is the unleaded gas. This is where the number was bad, and then it just rallied. This is heating oil. This is where the number was bad, and then it rallied. So the tone in crude here is pretty darn good, I think. In particular, given how many people I believe are bearish based on the charts, based on the underperformance and all that. So I am not long that stuff. I am long natural gas. Natural gas had a nice day today. It was actually, let me check if this is correct, but it was the best performing asset on the planet today, up over 6%. The second best, by the way, was crude, up 2.5%, right? And then heating oil and Brent crude. These were the best, and then RBOB, unleaded gas. So these were the best performing assets in the world today. All outperformed the Nasdaq, as a side note. So that's the crude story. Gold went up, which it should have, because again, the inflation expectations go up. Silver, surprisingly, did not. It went up at first, and then it failed. Silver's been pretty shitty. Not much more to say other than that. And the dollar went up, right? We had an interesting thing in Canada today where they cut rates 50, which was expected. And the Canadian dollar went down and then rebounded immediately. But again, what don't we do? We don't chase markets higher at 10 o'clock in the morning. We wait to see if there's any kind of value at the end of the day. And really, Canada closed flat. And given that the rate cut was right on expectations, given that the speech, I would argue, from the central bankers was, I would call it slightly more hawkish than probably expected in many ways, I don't think there was anything here. I'm still not looking to short dollar. I would like to, but the positioning just doesn't allow it for me just yet. So I'm sitting and I'm waiting on that. And then we had Bitcoin, which just had a ripper, almost back to all-time highs, right? Just about back to all-time highs. Which again, you know what I mean? Inflation, which is bad for fiat currencies. This is all good for Bitcoin. So that, I believe, is why it went up today again. So that was really, I think, the main themes of the day as far as stocks goes. Look, bull market, hard to argue with. The NQ over TLT today made new highs. Bonds, people are wondering, why are bonds going down when the inflation number was at or arguably a little better than expected? And I will keep saying it. I've been saying it for a long time, and I will keep saying it. The Fed cutting rates in an environment that is flushed with liquidity is bad for bonds, in particular the long end. And when will this bond thing affect stocks? That's everybody's big question, and has been everybody's big question for quite a while. And I will make the argument, right or wrong, that it won't really matter until they do something other than discount in growth, right? 10-year rates at 4 to 4.5% when GDP growth is expected to be 3% is really not a problem. It's normal, right? GDP growth at 3% and 10-year rates start to go to 6%, you got yourself a problem, okay? But we aren't there yet. Could we go there? Sure, but I don't think it's going to be a problem until bonds are doing much worse than they would be expected to do given future growth and inflation expectations, right? That's what bonds are supposed to do. They're supposed to price in future growth and inflation expectations. But when they start running away from that, that's when I think you're going to have a problem in everything. But we haven't gotten there yet. We're not even close there yet. So something to keep an eye on and something I will talk about should it start to happen. But that's really the main theme there. Okay. So that's my thoughts for today on this rainy Wednesday. I hope that helps. Please like the video. If in fact you liked it, please check us out, crowdedmarketreport.com. You know the drill. We have all these free YouTube videos. We have free Substack. If you go on Substack, you can sign up for that. And I'd love to hear questions and comments because I'm wrong on things. And the only way for me to find out when I'm wrong or when I could be wrong is by hearing from other people, giving me what they think and pointing these things out to me that I may be missing. Okay. So thanks for listening, and we will talk again soon. Bye.